So usually when we look at corporate earnings, there's this expectation of precision.
Yeah, exactly.
You look at the financial statements, and the revenue just shows this clear, undeniable number. The analyst points to it, and, well, that's supposed to be the perceived health of the business.
Right. It's either up or down, black or red.
Exactly. We like things to be visible and perfectly categorized, so our financial models just hum along smoothly.
Yeah.
But then, and here's where it gets tricky, you step into the world of global automotive supply chains.
Oh, yeah. Which is incredibly messy right now.
It really is. You add in macroeconomic volatility and corporate restructuring, and suddenly that nice financial x-ray machine is just completely broken.
Completely broken. You are staring at a diagnostic landscape that is incredibly murky.
Right, and largely because the subject on the table is about to undergo this radical structural transformation.
Which, completely invalidates the traditional static way of evaluating a quarter's performance.
It really does.
When a company is on the precipice of dividing itself into two entirely separate public entities, backward-looking metrics just lose a lot of their utility.
Yeah, you are no longer analyzing a single corporate organism.
Right. You're trying to project how two distinct specialized DNA strands will survive and compete in completely different market environments.
So welcome to the deep dive. Our mission today is to cut through all that corporate noise and break down the Q4 2025 earnings call for Aptiv PLC.
Ticker symbol APTV.
Right. This is a monumental quarter because Aptiv isn't just reporting numbers. They're preparing to execute a full corporate mitosis set for April 1st, 2026.
It's massive.
It is. And look, by the time we wrap up this deep dive, you will have a clear, actionable stance on whether you should buy, hold, or sell ahead of this big split. So let's just dive straight into the top line data.
Let's do it.
For the fourth quarter of 2025, Aptiv reported record revenue of $5.2 billion.
Which sounds great on paper.
Right, it does. Now, on a reported basis, that is a 5% year-over-year increase. But on an adjusted basis, the growth sits at 3%.
And that delta between those two figures, the reported versus adjusted, that is where we find the first critical thread of this quarter's narrative.
Yeah, break that down for us because it's important.
Well, Wall Street models often lean heavily on the adjusted figure, right? Because it strips out the noise of M&A activity, or more significantly in the specific quarter, currency fluctuations.
Right.
It attempts to isolate the organic growth of the actual products going out the door.
I gotta be honest though, I always look at relying purely on adjusted revenue figures, like, well, stepping onto a bathroom scale while casually leaning your elbow on the counter.
That is a great way to put it.
Right, because it just makes the reality look a little better than it actually is.
Yeah, it hides a lot of the actual operational pain.
It's exactly. In Aptiv's case, while the top line reported revenue of 5% might have caught a cosmetic tailwind from external factors, prioritizing those adjusted operating income numbers obscures massive real-world cash flow issues.
Because you can't pay your factory workers with an adjusted currency.
Exactly. You could adjust a spreadsheet to show investors the theoretical performance of the core business, but you pay your employees in fiat.
Right. And to their credit, management actually acknowledges that friction in the footnotes of this release.
Yeah, they do.
They delivered $607 million in adjusted operating income and $1.86 in earnings per share.
Right.
But when you look at the $818 million in operating cash flow for the quarter, you see the actual resilience of the model.
Yeah, despite a really messy macroeconomic backdrop.
Exactly. They are operating in a sluggish global vehicle production environment, yet they still converted product volume into tangible capital.
Which is impressive.
It is. They took that cash flow, which was well over $2 billion for the full fiscal year, and aggressively re-engineered their balance sheet.
Right, they retired $1 billion in debt.
Yeah, deleveraging ahead of the spinoff, and they deployed $3.5 billion towards share repurchases since the third quarter of 2024.
Look, retiring a fifth of your outstanding shares in that time frame is a massive capital allocation decision.
Oh, completely.
A 20% reduction in the float artificially supercharges that $1.86 EPS figure, making every remaining slice of the corporate pie significantly larger.
Right, and some might critique that.
Oh, for sure. Some might critique that as pure financial engineering, saying they'd prefer to see that $3.5 billion plowed into R&D or, acquisitions.
Right. But the counter argument there is capital efficiency in a mature cyclical market.
Expand on that a bit.
Well, if the macroeconomic environment doesn't offer a high return avenue for organic capital deployment because automakers are, tapping the brakes on new vehicle platforms, the highest yield for shareholder value is returning that cash directly.
It basically signals that management believes their own equity is undervalued relative to the cash on hand.
Exactly, especially considering the embedded value of the upcoming software and robotics spinoff, which we will get into.
Right. But before we get to the spinoff, let's pull the lens back from the corporate balance sheet and look at the physical map of this revenue.
Yeah, geography is huge here.
Because you can't analyze a tier 1 supplier as a global monolith. You really have to isolate the regions.
Right.
And North America was the undeniable powerhouse for Aptiv this quarter. They generated an 8% revenue increase there.
Which is wild because the North American consumer has continuously defied broader recessionary anxieties.
Yeah, people keep expecting a pullback, and it just hasn't happened.
Exactly. That 8% growth was driven heavily by robust demand in both their intelligence systems and their electrical distribution systems.
Because automakers in Detroit are still pushing heavily into high-content vehicles.
Right. The big trucks and premium SUVs. And those are loaded with advanced driver assistance systems, or ADAS.
Which require the exact high-end architecture that Aptiv supplies. Meanwhile, though, the European market is virtually flatlining. They came in down 1% for the quarter.
Which tracks perfectly with the broader macroeconomic malaise across the Eurozone.
Right. You look at the GDP growth expectations in Germany or France, combined with legacy European automakers scaling back their aggressive EV transition timelines.
Because of a lack of consumer demand and infrastructural bottlenecks.
Exactly. So Aptiv's performance in Europe is effectively tethered to a stagnant production environment.
Yeah, it's a holding pattern there. But the most nuanced geographical data point, however, is China.
Yes, China is fascinating this quarter.
Revenue in the region was down 5% in the fourth quarter. Now, if an analyst simply screens for negative regional growth, they might conclude Aptiv is losing its footing in the largest automotive market in the world.
Right. They see -5 and hit the panic button.
Exactly. But management cited an unfavorable mix, which requires translating the underlying structural shift in Chinese auto manufacturing.
Yeah, let's unpack that, because historically, Western suppliers like Aptiv built their Chinese revenue base by supplying the legacy joint ventures.
Right, the old guard.
Right. You had Western giants like Volkswagen or GM partnering with state-owned entities like SAIC Motor. For decades, that was really the only way to play the Chinese market.
But that paradigm has just completely shattered over the last 36 months.
But completely. The domestic Chinese OEMs, companies like BYD, NIO, Xiaomi, Li Auto, they are aggressively capturing domestic market share.
They are vertically integrated, they move incredibly fast, and they are out innovating the legacy joint ventures in the battery electric space.
So if your revenue base is historically tied to those legacy joint ventures, your sales mix becomes unfavorable the moment those legacy brands start losing volume.
You bleed market share concurrently with your legacy customer.
Exactly. And that explains the current 5% drag. But, and this is huge, the CFO dropped a strategic metric that changes the entire trajectory of that narrative.
The 80% stat.
Yes. Roughly 80% of Aptiv's 2025 new business awards in China came from local domestic OEMs.
I mean, that is staggering. They booked almost $4 billion in new business in China, and 80% of it is with the local winners who are actually dominating the transition.
Which is an incredibly difficult pivot for a Western supplier to execute. The culture clash between a legacy Western engineering cycle and what the industry refers to as China speed is notorious.
Oh, yeah. Legacy automakers typically operate on a 4 to 7 year vehicle development cycle.
While the Chinese ED startups are rolling out entirely new architectures in, 18 to 24 months?
Exactly. And management highlighted a specific data point regarding a Gen 7 radar system they launched for a local Chinese OEM.
The time to market on that was insane, wasn't it?
4 months.
Wow.
4 months. Architecting, testing, validating, and scaling an automotive-grade safety-critical radar system in 120 days proves that Aptiv has successfully localized its engineering teams.
Yeah, they aren't relying on a centralized engineering hub in Dublin or, Troy, Michigan to dictate product timelines.
No, they have decentralized their intellectual property development to match the velocity of their new client base.
So enduring a 5% revenue compression today is basically a strategic tax. You happily pay it if it means your future revenue pipeline is tethered to the companies actually projected to manufacture the majority of global EVs by the end of the decade.
Absolutely. It's short-term pain for long-term survival.
Right. So let's pivot from the geographical map to the macroeconomic friction.
The headwinds.
Yeah, management pointed to a series of severe headwinds that dragged down margins this quarter, and the primary offender requires us to examine the Mexican peso.
And this circles right back to the dangers of ignoring real-world cash impacts in favor of adjusted metrics, like you mentioned earlier.
Exactly.
Aptiv operates a massive manufacturing footprint in Mexico, primarily producing complex electrical distribution systems or wiring harnesses for the North American market.
Right. And these facilities, the maquiladoras, they sit at the absolute heart of their cost structure.
Yeah, and we need to explain what a wiring harness actually is, because it's not just a single wire.
No, it is essentially the nervous system of the vehicle. It's miles and miles of copper wire bundled tightly, branching off into hundreds of specific connectors to power everything from the infotainment screen to the braking sensors.
And despite all the advancements in industrial robotics, building a flexible, chaotic, heavy bundle of wires is notoriously difficult to automate.
Right. You can't easily program a robotic arm to thread a flimsy wire through a tight, obscure plastic channel. It requires human dexterity.
Therefore, the production of these harnesses remains incredibly labor-intensive.
Tens of thousands of workers manually routing wires on massive pegboards.
Exactly. And because of that labor density, Aptiv's single largest operating expense in the segment is the Mexican workforce, and those wages are paid in pesos.
Right. So in late 2024, when management was building their 2025 financial models, the exchange rate was hovering comfortably around 21 pesos to the US dollar.
They budgeted at a conservative 20.75, I believe.
Yeah, but then the macroeconomic tides shifted. The US dollar weakened relative to the peso, driving the exchange rate down to sub 18.
And the mathematical consequence of that is just brutal. Every individual peso required to meet payroll suddenly costs Aptiv significantly more US dollars to acquire.
Right, so their labor costs, measured in the dollars they report to Wall Street, spiked dramatically without a single factory worker receiving a wage increase or a single additional product rolling off the line.
It compresses operating income immediately.
Now, the CFO mentioned they are 90 to 95% hedged below 18 for calendar 2026. They are utilizing financial instruments to lock in exchange rates and insulate the balance sheet going forward.
Which is smart, but for 2025, that volatility acted as a severe, unmitigated drag.
Yeah, it really highlights the vulnerability of cross-border labor arbitrage. You are always exposed to the monetary policy of two completely disparate central banks.
Right. And beyond currency, physical commodities created their own massive margin pressure.
Let's get into that. The transition to electric vehicle architectures structurally increases the demand for raw materials.
Copper is the obvious factor here.
Yeah. An internal combustion engine vehicle might utilize, 40 to 50 pounds of copper wiring?
Roughly, yeah. But a modern battery electric vehicle can easily demand 150 to 180 pounds of copper just for the high voltage architecture alone.
That is a massive jump. So as global EV penetration slowly climbs, the baseline demand for copper fundamentally shifts, driving the commodity price upward.
Right. But the more unexpected margin pressures came from precious metals, actually. Gold and silver.
Which sounds completely counterintuitive, right? Like, why would a tier one auto supplier cite gold prices as a headwind?
It sounds like they're building luxury trim pieces, but it actually exposes the underlying physics of modern automotive engineering.
Exactly. We aren't talking about gold-plated cup holders here. We're talking about the engineered components segments, specifically the physical data connectors.
Right. Because modern ADAS platforms, the radars, the LiDAR, the high-definition cameras, they are transmitting gigabytes of raw, uncompressed data per second back to a central compute unit.
And that data must flow instantaneously. Any degradation in signal integrity, any microscopic latency caused by corrosion or poor conductivity?
It could literally mean the difference between the autonomous emergency braking system identifying a pedestrian in time or failing entirely.
Exactly. And silver and gold boast some of the highest electrical conductivity ratings on the periodic table.
And crucially, gold is highly resistant to oxidation and corrosion.
Right. So to guarantee that a data connector will survive a decade of thermal cycling, vibration, and moisture in a vehicle engine bay without losing a microsecond of signal speed, those terminal pins are meticulously electroplated in precious metals.
So when global macroeconomic fears drive spot prices for gold and silver to record highs, Aptiv's raw material costs for these microscopic mission-critical components surge proportionally.
Yeah, they really can't catch a break on the macro side. But while management was forced to navigate those currency and commodity headwinds defensively, they took a remarkably offensive, aggressive posture regarding semiconductor supply.
Oh, this was fascinating. This strategic maneuvering discussed on the call regarding memory chips represents a masterclass in supply chain risk management.
It really does. Look, the automotive industry is still nursing the deep psychological scars of the 2021 semiconductor famine.
Nobody wants to repeat that.
No. And the transition to advanced vehicle architectures requires an exponential increase in compute power. The industry relies heavily on mature node chips, specifically DDR3 and DDR4 memory modules, to run these systems.
And over the last few quarters, systemic warnings have flashed across the global supply chain, indicating a massive impending shortage of these specific memory architectures.
Why is that happening now?
Well, the semiconductor foundries, the TSMCs and Samsung Electrics of the world, they are aggressively allocating their finite wafer fabrication capacity toward high-margin, cutting-edge AI chips.
Right, NVIDIA H100s and advanced data center silicon.
Exactly. They are crowding out the older, lower-margin legacy nodes that the automotive sector relies upon. So supply for DDR3 and DDR4 is artificially constricting, and spot market prices are forecasted to spike by 100-220% globally.
That is terrifying for an automaker. So faced with that systemic risk, Aptiv didn't just write hopeful procurement models, they weaponized their balance sheet.
They absolutely did.
Management utilized hundreds of millions of dollars in operating cash flow to physically stockpile semiconductor inventory. They're currently sitting on a 12-week coverage ratio of physical chips secured in their own warehouses.
It is the corporate equivalent of buying up the entire grocery store aisle of toilet paper right before a pandemic hits.
That is the perfect analogy. They essentially walked into the global supply chain, recognized the impending bottleneck, and aggressively bought out the entire inventory months before the shortage materialized.
Right. And they're committing an additional $200 million investment in 2026 purely to sustain that elevated inventory buffer.
And this isn't irrational hoarding either. CFO Varun Laroya explicitly noted that a significant portion of this inventory build was mandated and in some cases directly funded by the OEM customers themselves.
Because the automakers are so terrified of repeating the multi-billion-dollar production line stoppages of 2021 that they are actively capitalizing Aptiv to hold safety stock on their behalf.
Yeah, they were basically paying Aptiv to be their insurance policy. But the real masterstroke was revealed during the Q&A session when analyst Dan Levy probed CEO Kevin Clark on their financial exposure to this memory market.
Right. This is where the numbers get really interesting. Clark disclosed that Aptiv's total memory purchase value for 2026 sits around $175 million.
Okay.
But rather than facing the 100% market price inflation forecasted by industry analysts, Clark confirmed that Aptiv's price increases for the calendar year are contractually locked in at low double digits.
Wow. By negotiating long-term fixed price contracts years in advance and taking physical delivery of the inventory early, they completely bypass the spot market chaos.
Completely. The broader market will bleed capital paying double for memory chips, while Aptiv absorbs perhaps a 10 or 15% increase.
Furthermore, Clark projected immense confidence in their ability to pass even those low double-digit increases directly through to the OEMs via commercial recovery agreements.
So they insulated their 2026 production completely. And they are already negotiating 2027 foundry contracts from a position of profound leverage.
Which is incredible foresight. And securing that supply chain is critical not just for their automotive clients, but for the aggressive pivot management is engineering outside the traditional mobility sector.
Yeah, the robotics pivot.
Exactly. The structural narrative of this earnings call was deeply intertwined with their non-automotive growth strategy. Total non-automotive revenue expanded by 8% for the full year, significantly outpacing the core auto business.
And in the fourth quarter, their industrial revenue segment actually grew faster than their commercial vehicle segment.
Which makes sense. The underlying logic is totally sound. The secular megatrends that define modern automotive engineering, so electrification, massive data processing, sensor fusion, and autonomous navigation, they are entirely agnostic to the form factor of the machine.
Right. A radar module doesn't care if it is mounted to the bumper of a luxury SUV or the chassis of an industrial warehouse robot.
Exactly. Management highlighted two major strategic partnerships this quarter, anchoring this pivot into the robotics sector: Robust AI and Vetna Robotics.
Yeah, these companies design and deploy autonomous mobile robots, or AMRs. and collaborative robots designed to safely navigate chaotic, human-dense environments.
Right, like massive e-commerce fulfillment centers or advanced manufacturing floors.
And the hardware crossover is obvious. An AMR needs LiDAR, high-definition stereo cameras, and ultrasonic sensors to build a spatial map of its environment.
It needs a central compute unit to process that sensor data in real time, and it needs ruggedized, high-speed data connectors to link the physical architecture.
And Aptiv manufactures that entire hardware stack.
But the truly differentiated intellectual property, the true value driver in this $6 billion total addressable market, is software.
Yes. Which brings us to the strategic acquisition of Wind River.
Wind River is really the foundational layer of this non-auto pivot. You develop VxWorks, which is a real-time operating system, or RTOS.
And the distinction between a standard operating system and a real-time operating system is absolutely critical for you to grasp here.
Yeah, let's explain that. If you are running a general-purpose operating system like Windows or standard Linux on a laptop, and the CPU gets bogged down processing a background task, your cursor might freeze for a few hundred milliseconds.
Right, and in consumer electronics, that latency is just a minor annoyance.
But if a 2,000-pound autonomous forklift is moving at 15 miles per hour across a crowded warehouse floor, and its operating system pauses for 200 milliseconds to prioritize a background data log,
the robot travels several feet entirely blind.
Exactly. In industrial automation and automotive safety systems, latency is fatal.
And that is where VxWorks comes in. It guarantees deterministic microsecond response times.
It dictates that critical safety tasks absolutely must execute within a rigidly defined time constraint, completely preempting any lower priority compute loads.
And that level of bulletproof software reliability is exactly why VxWorks runs the avionics on commercial jetliners, the control systems on the Mars rovers, and now the autonomous brains of next-generation industrial robots.
It's incredible tech. CEO Kevin Clark actually drew a fascinating parallel regarding the unit economics of this market.
Yeah, he compared it directly to the auto sector.
Right. In the automotive sector, supplying the full ADS hardware, software, and high-voltage architecture for a premium vehicle might generate $4,000 to $5,000 in revenue per unit.
And Clark indicated they are targeting that exact same revenue density per robot in the industrial space,
which completely reframes the growth ceiling for the company. If global automotive production remains suppressed for the next 5 years, Aptiv can theoretically transpose their core engineering IP directly into the exponentially growing warehouse automation sector without designing a single new underlying technology.
They're just selling the exact same brain into a different mechanical body.
Exactly. And that transition from a traditional hardware supplier into a high-margin, software-defined technology provider serves as the perfect catalyst to examine the mechanics of the impending corporate split.
Because on April 1st, 2026, the market will force a brutal reevaluation of this business as it legally separates into two independent, publicly traded entities.
Right. And we need to be clear here. This isn't a divestiture or the sale of an underperforming division to private equity. It is a full spin-off.
Right. Current shareholders will find their single APTV equity position split into two distinct tickers.
And management provided granular financial guidance for how these two entities will operate in isolation. So let's dissect New Aptiv, historically referred to as RemainCo, first.
Okay. New Aptiv is the entity absorbing the high-tech, software-driven autonomous portfolio. It retains the intelligent systems and the engineered components segments.
Right, so this is the company housing the radar IP, the Wind River software stack, and the high-speed data connectors.
Exactly. Now, management guided 2026 revenue for New Aptiv between $12.8 billion and $13.2 billion.
At the midpoint, that represents roughly 4% top-line growth.
And critics might argue that 4% falls short of the aggressive 4 to 7% long-term compounded annual growth targets touted during their last investor day.
Yeah, people might be a little disappointed by that. But the subdued top-line guidance is really just a concession to the macro reality we discussed earlier.
Right. While the robotics and industrial segments are growing at double-digit rates, they remain a minority percentage of the total revenue mix.
The bulk of New Aptiv's immediate revenue remains tethered to global vehicle production volume, which is currently a decelerating metric.
But the true fundamental story of New Aptiv isn't the top-line revenue. It is the margin profile.
Yes, the margins are where this gets exciting. Management is projecting $2.42 billion in EBITDA for 2026.
Which is earnings before interest, taxes, depreciation, and amortization. It is the purest metric of operational cash flow profitability before capital structure and tax jurisdictions muddy the water.
And that $2.42 billion translates to an 18.6% EBITDA margin.
That is massive.
For context, legacy automotive hardware suppliers typically fight tooth and nail for high single-digit margins. An 18.6% margin is a software multiple.
It absolutely is. It reflects the immense pricing power of proprietary intellectual property like VxWorks versus, commoditized metal bending.
And crucially, that 18.6% margin is artificially compressed by structural friction related to the spinoff.
Right. Management detailed roughly $50 million in stranded costs for the 2026 fiscal year.
Yeah, when you execute a massive corporate mitosis like this, you invariably generate structural redundancies. A massive global HR department, unified IT infrastructure, executive suite leases.
Those fixed costs were previously amortized across a $20 billion global conglomerate.
Exactly. When the spinoff company departs, taking its share of the revenue, new Aptiv is temporarily stuck holding the bag on these centralized corporate expenses until they can legally untangle contracts, execute layoffs, and resize the operational footprint.
So that $50 million is just dead weight, temporarily dragging down the margin.
Furthermore, they're absorbing a $35 million hit in planned strategic R&D and go-to-market investments, specifically targeting the new robotics verticals.
Right. So if you strip out the temporary friction of the stranded costs and the aggressive forward-looking investments, the core operational margin of new Aptiv's existing business is actually trending significantly higher than 18.6%.
It's incredibly healthy. Combine that profitability with the projection that new Aptiv will pay down $1.9 billion in debt in 2026, and you are looking at an exceptionally lean, highly capitalized technology firm.
But we have to examine the other side of the ledger, the spin-off entity, which management has dubbed Versagen.
Right. Versagen, or Spinco, inherits the entirety of the electrical distribution systems business.
This is the legacy labor-intensive manufacturing operation, the maquiladoras, the miles of physical copper wiring we talked about.
And the financial architecture of Versagen sits in stark contrast to new Aptiv. Revenue guidance for 2026 is modeled between $9.1 billion and $9.4 billion.
Representing a sluggish 2% growth at the midpoint.
Yeah. But more importantly, the projected EBITDA sits at $990 million, yielding a margin of just 10.7%.
And that chasm between an 18.6% margin and a 10.7% margin dictates how institutional investors will fundamentally value these two equities.
Absolutely. Versagen operates a necessary business. The transition to high-voltage EV architectures guarantees sustained demand for complex wiring harnesses. And that vulnerability is highlighted perfectly by a single data point dropped by the CFO regarding copper pricing.
Yeah, this blew my mind. Versagen is modeling copper at $5.50 per pound for 2026. In 2025, their blended cost was roughly $4.51 per pound. So that dollar per pound increase in raw material costs translates into a nearly $200 million mechanical drag on Versagen's top-line revenue growth for the year.
$200 million just vanishing because of the cost of copper. Now, they mitigate that risk through commercial indexing agreements.
Right. Approximately 70% of that copper inflation is contractually passed through to the automaker.
But those indexing agreements operate on a severe lag, often 3 to 6 months. Versagen has to physically purchase the expensive copper today, build the harness, ship it to the assembly plant, and then wait quarters before they can recoup the inflated costs from the OEM.
It is an incredibly punishing dynamic for cash flow management in a high inflation environment.
They're projecting $250 million in free cash flow, which proves the business is solvent and capable of internal funding.
However, an immense portion of that capital will immediately be consumed by necessary footprint rotation.
Right. They must aggressively invest in automated manufacturing equipment and shift production out of high-cost labor zones, even within Mexico, just to tread water against the escalating wage pressures and currency fluctuations we analyzed earlier.
Which brings us to the immediate warning management issued for the first quarter of 2026.
Yes, we have to talk about Q1. Because the split doesn't execute until April 1st, the Q1 financial reporting will still represent the combined legacy Aptiv entity. And the guidance for those 3 months is, well, decidedly weak.
Very weak. They are projecting a mere 1% in adjusted revenue growth, targeting $5.05 billion for the quarter.
And why is that? Management cited predictive data from IHS Markit forecasting that global vehicle production will contract by 4% in the first quarter.
Yeah, when you operate as a Tier 1 supplier, your short-term visibility is entirely subjugated to the production schedules of your OEM customers.
If Ford or Volkswagen idle an assembly line for 2 weeks to bleed off excess dealer inventory, Aptiv's product simply sits on the shipping dock.
And CEO Kevin Clark was exceptionally candid about this structural vulnerability. Their concrete visibility only extends 4 to 6 weeks out, based purely on the physical manufacturing orders pulled by the automakers.
And the macro indicators for Q1 suggest a sharp deceleration in assembly line velocity across North America and Europe.
Right. Clark attempted to cushion the blow by indicating they anticipate a strengthening demand curve in the back half of the year, relying on longer-term forecasting models.
But the immediate reality requires Wall Street to aggressively reset near-term expectations. The first quarter will be a slog. The true financial catalyst relies entirely on the structural unlock provided by the April 1st split.
So this forces us into the ultimate synthesis of this deep dive.
Exactly. We have dissected the balance sheet, translated the macro headwinds, analyzed the semiconductor strategy, and examined the financial disparity between the impending entities. Now, we must formulate the definitive, actionable thesis for the capital allocator.
What is our stance here?
Our stance heading into the April 1st mitosis is heavily bifurcated. We hold a strong, high-conviction, bullish thesis on new Aptiv. Conversely, we maintain a highly cautious defensive posture regarding Versagen.
And the foundational logic for the new Aptiv bull case is the successful execution of a strategic pivot that legacy industrial suppliers almost universally fail to achieve.
They are systematically excising the heavy, low-margin, labor-intensive manufacturing baggage that has artificially compressed their valuation multiples for decades.
Right. What remains is a pure-play technology firm commanding an 18.6% EBITDA margin.
They control highly defensive, proprietary intellectual property in Wind River. They possess an insulated, brilliantly hedged semiconductor supply chain.
And most importantly, they are successfully decoupling their growth ceiling from the stagnant legacy automotive production cycle by pushing aggressively into a $6 billion TAM in industrial robotics and AMRs.
It's a fantastic setup, but the caution applied to Versagen is equally systemic. It remains fundamentally tethered to the vulnerabilities of the old world.
Yeah. While the executive team operates the business with high efficiency, the margin profile is inherently fragile.
A 10.7% margin leaves very little shock absorption for exogenous macro events. Their quarterly profitability will continuously remain at the mercy of unpredictable variables.
Like the spot price of copper on the London Metal Exchange, the hawkish or dovish monetary policy of the Mexican Central Bank, and the erratic, week-to-week production halts of legacy automakers struggling to manage their own inventory gluts.
It's just a much tougher business. This requires decisive action from the retail investor. If your portfolio currently holds legacy APTV equity, on the morning of April 1st, your brokerage account will reflect positions in both new Aptiv and Versagen.
Now, holding both passively really defeats the entire strategic purpose of the spinoff.
It does. It recreates the exact blended compromise valuation multiple the executive team is desperately trying to escape.
Plus, the passive index funds will be forced into mechanical rebalancing on the day of the split.
Yeah, explain that mechanic for everyone.
Well, many thematic or technology-focused ETFs that currently hold Aptiv will automatically dump the Versagen shares, right? Because a pure-play wiring harness manufacturer no longer meets their prospectus criteria for a high-tech or software holding.
Oh, right. And that automated selling pressure often creates severe short-term pricing dislocations in spin-off equities.
Exactly. So the active retail investor must interrogate their own underlying investment thesis.
Are you allocating capital to capture the commodity-heavy, labor-intensive, cyclical transition of automotive hardware? Or are you betting on the high-margin, software-defined proliferation of artificial intelligence, spatial computing, and industrial robotics?
I think the choice is pretty clear. If the latter defines your strategy, the actionable path is to liquidate the Versagen position shortly after the spin-off mechanics settle and aggressively reallocate that capital to concentrate your exposure entirely within new Aptiv.
Let the passive dividend funds absorb the cyclical risk of the wiring harnesses. Concentrate your portfolio in the high-margin growth engine.
Which leaves us with one final structural concept to consider. The ultimate prize management is hunting for with this entire maneuver.
Yeah, it wasn't explicitly modeled in the financial guidance, but it represents the most significant potential upside for the equity.
The phenomenon of valuation multiple expansion.
Look, for the entirety of its modern existence, Wall Street has valued Aptiv through the lens of a traditional automotive supplier. They trade at a compressed price-to-earnings multiple relative to the broader market because automotive hardware is viewed as a commoditized, capital-intensive, slow-growth sector.
But if new Aptiv successfully executes this divorce, sheds the heavy industrial drag of Versagen, and begins reporting quarter after quarter of mid-teen software revenue growth driven by industrial robotics and AI integration,
Then the critical threshold is reached. It happens when the algorithmic trading models and the institutional analysts stop benchmarking new Aptiv against companies like Magna International or Lear Corporation and begin benchmarking them against Silicon Valley software firms or high-margin semiconductor designers.
Right. If the broader market eventually recognizes new Aptiv not as a car parts manufacturer, but as a pure-play, high-margin AI and robotics operating system company, the valuation multiple expands exponentially.
A company commanding a software, multiple trades at a fundamentally different atmospheric level than a metal bender. That structural repricing of the underlying equity is the paradigm shift you were betting on.
And it demands that investors look past the stagnant 1% growth of Q1 and focus entirely on the architectural purity of the entity emerging in Q2.
Exactly. Thank you for joining us on this deep dive. We've cut through the noise, translated the macro mechanics, and provided the analytical framework necessary to navigate this corporate transformation.
You are now equipped with the context required to dictate your own strategy before the April 1st split.
Keep a close eye on those copper spot prices, monitor the velocity of the Chinese EV domestics, and watch the industrial robotics sector for the true long-term catalyst. Until next time, keep diving deep.